Hello everyone, welcome to my channel. Today I'm going to talk about how becoming a real estate professional unlocks tax advantages for landlords. Let's get into the video. In the complex world of real estate, understanding the tax implications of your professional status is crucial. The Internal Revenue Code has specific criteria that defines a real estate professional, along with distinct tax rules that apply and which the Internal Revenue Services (IRS) is charged with enforcing. In this video, I look into the qualifications necessary to be recognized as a real estate professional for tax purposes and explores the significant tax ramifications associated with this designation. Qualifications to be a real estate professional. To be considered a real estate professional by the IRS, an individual must meet two primary qualifications within a tax year. One is more than half of personal services must be in real property trades or business. The first criteria requires that over half of the professional services you perform in any trade or business during the tax year are in real property trades or businesses in which you materially participate. This ensures that most of your professional effort is dedicated to the real estate sector. The second one is minimum of 750 hours of service. The second qualification stipulates that you must perform more than 750 hours of services during the tax year in real property trades or business in which you materially participate. This quanti- quantifiable measure ensures a significant time investment in real estate activities. It's important to note that these qualifications apply on an individual basis, meaning that for married taxpayers filing jointly, one spouse must independently meet this criteria without considering the services of the other spouse. Tax ramification of being a real estate agent. Being classified as a real estate professional carries significant tax implications, primarily related to the treatment of rental real estate activities and passive activity laws (PAL) rules. Treatment of rental real estate activities. Typically, this situation applies to real estate agents or brokers who personally own real property that they rent out. Generally, rental activities are considered passive and losses from these activities can only be deducted against passive income. However, real estate professionals are defined for tax purposes, can treat losses from rental real estate activities in which they materially participate as non-passive. This allows them to deduct these losses against other types of incomes, such as wages or business income, potentially resulting in substantial tax savings. Material participation and record keeping. To benefit from the non-passive loss treatment, real estate professionals must demonstrate material participation in their rental real estate activities. This typically involves participating in the activity for more than 500 hours during the tax year. It is crucial for real estate professionals to maintain meticulous records of their participation, including hours worked, to substantiate their claims in case of an IRS audit. Next, the election to aggregate rental real estate interests. Real estate professionals have the option to elect to treat all their interests in real estate as a single activity. This election can simplify the process of providing material classification across multiple properties. However, once made, this election is binding for the tax year it's made and for all future years in which the taxpayer qualifies as a real estate professional. Closely held corporations. It's also worth noting that closely held C corporations can qualify as real estate professional if more than 50% of their gross receipts for the tax year are derived from real property trades or business in which they materially participate. The designation of real estate professional is not merely about the title, but has profound tax implications that can affect your financial landscape. The ability to deduct real estate losses against other income can lead to significant tax savings, making it a coveted status among real estate investors. However, the IRS stringent criteria and the necessity for detailed record-keeping underscore the importance of diligence and accuracy in pursuing this designation. Moreover, the tax playing field is ever-evolving, and numerous court cases highlight the critical nature of understanding and correctly applying the rules. For instance, the case of Gregg versus Commissioner emphasized the necessity of proving material classification in rental activities, separate from one's profession as a real estate agent. In this case, when the IRS audited the taxpayer's return, the service requested a written log of all rental-related activities that would support the deductions claim. In response, the Gregg submitted two updated one-page notes estimating the hours Mr. Gregg spent working on the Gregg rental properties in the tax year under audit. The court found that the notes were insufficient to prove that Mrs. Gregg had materially participated in the rental activities, and the fact that she worked as a professional real estate agent did not automatically qualify her as a tax professional for tax purposes. The takeaway from this case is the importance of maintaining competences written records documenting dates, time spent, and description of each activity related to the rental property. Achieving the status of a real estate professional for tax purposes requires a careful balance of time, investment, and strategic planning. The benefits, particularly regarding the treatment of rental losses, can be substantial, but they come with the responsibility of meticulous document and adherence to IRS rules. Thanks for watching this video and do not forget to subscribe to my channel.